What's up? What's up, everybody? Good morning to those that are in Central Texas, Central time zone, I guess. We got people from the East Coast listening. We got people from the West Coast listening. Just want to say welcome to the Real Estate Power Play on this awesome Tuesday. We have some awesome guests going on. We have a good buddy of mine. I have Ronnie here, guys, that those who know Ronnie, who's been part of this for so long, since the very beginning, and helping us grow. So, Ronnie, how you been, man?
I've been doing good, man. We've got a lot going on. We've got real estate going on. We've got traveling going on. We got family stuff going on. We got 6 flips going on.
Wow.
Yeah, there's a lot, man. It's been good. I know I've been gone for a little bit, but it's not from lack of activity. It's actually probably because of the activity that you guys have not seen me as much. So I'm looking forward to today, though. We got Derek, my man. We got Derek on here. What are we talking about today?
Hello. Well, yeah. What's up, guys? Yeah, I'm in Virginia now. I was in Texas for a long time. Known Gabe for several years. And we were just talking, and I'm a full-time investor, but I'm also big into whole life insurance. And I think that's a hot button for a lot of people. And if I can maybe explain some of that, I'd love to, and how I use it, or how to use it. And so I'm here to answer questions and talk about it. So I'm excited.
Yeah, this is going to be good. Ronnie has a policy, guys. So what we're going to do here, before we jump in too much further, I would just want to set it up going, look, if you like the content that we're providing, ask questions. We're totally open to getting answers for those who are maybe newer to real estate investing, or just want some answers on some of the creative strategies that we do for real estate investing. Mark does a lot of really cool strategies. He's out of Florida, but he does all over. Marty, you guys see Marty on here a lot. He's the guy with all the energy that we need. All right. And he does a lot of cool, crazy stuff in upstate New York. And then we have Ronnie, who used to be at one point one of my coaches at one point, that has helped me grow my business and scale it. So he's really great at scaling and so many other things now. He's scaling now, flipping, which is a whole nother level. So if you guys have questions for anything like that, let us know. We'll be happy to help you out and help you grow. So let's jump into the whole show. Let's do it. Ready, Ronnie?
Yeah, let's make it happen. So I have a quick question, if you don't mind if I kick it off. So Derek,
do it.
First off, I freaking love your hat, bro. You need to send me one of those, and the beard that goes with it. I love it, bro. You look so good. So just that alone is gonna.
Ronnie is working on his beard. He's been working on his beard for quite a while. Just to let you know. And
yeah, I've of course got the baby face, So whole life policies, right? So insurance in general. How does insurance? Right before I heard about this, now I have my own whole life policy, right? And I have my own kind of, strategy, which we can get into, and I'll let you explain some of those. But where does insurance intersect with real estate? How is insurance a good financial move? Like, kind of give us the history of how you came into realizing insurance mixed with your real estate investing. Like, what's your history? What's your background? How did this come to fruition?
Yeah, good question. So I currently have 6 policies. Now, my first policy was in 2015. Okay. And so when I got my first policy, I probably studied this thing for a year or two prior, and I was confused just as much as most people are, because you go online and, you know, the Ramseys are like, this is stupid. And then you have these wealthy people saying it's the best thing ever. And there's just a lot of conflicting information. So I was really confused on that. And I sat down with agents. I'd met agents and they tried to sell me different things, and they tried to sell me IUL policies, which is indexed.
Yep.
Calling it whole life. I mean, it was a mess. Right. And so that's what really dug me into this. Now, at the time I was in Houston, talk about 4 flips. I had 4 flips at the time I was getting defrauded on. And so I was like, man, I had to come in and protect my lenders and stuff like that. So I had a partner who was taking some of the escrow money. But long story short, I got into these policies right before that. And my one policy helped me out a lot. And the reason it intersects with real estate is, for one, these policies are assets, right? For 2, you're going to use money. I know we use other people's money and we do stuff like that, but there's still things you can use your own money on. And what I found was every dollar that I put into a whole life policy is a dollar that's forever changed. The environment of that money is forever changed. There's tax benefits. There's all these benefits, right? The reason insurance comes into play is not because I love insurance. And I am an agent, by the way. I can explain that. I've been an agent since 2020. I didn't want to be an agent, and I don't mind being an agent. I just don't like the whole agent thing, because, you know, as you see, I'm not wearing a suit and a tie and greased back hair. I have a hat. Like, I'm like,
so funny story. I spoke to somebody just with what you're saying, and they're like, hey, I became an agent. I need to go out and buy like $10,000 worth of clothes to do it. I'm like, no, what are you talking about, bro? That's like fake success. That's not how you win. That's good. That's good.
A lot of agents don't even have policies, or if they do, it's very minimal and stuff like that. So,
right.
But yeah, so I got into this, and it intersected with investing, because look, if you're going to use, let's say you have $10,000 in your savings account, and you're like, all right, I'm going to buy a rental and use the 10K for a down payment, whatever it is, right? Just for a scenario. Well, you're going to use that money anyway. So if you have $10,000 in the savings account, you use 10,000, goes back down to 0. Now, obviously you're not making money. You're losing money big time.
Yep.
It goes back down to 0. Well, if I had $10,000 in my cash value of my whole life policy, I borrow against my 10K, but my 10K stays 10K. So my 10K is still making, 5-ish%, let's say. Now, I know that this account is a savings account on steroids. I'm not saying 5% is going to change your life. Obviously, we know it's not. However, you're making 5% on a account in this market environment. That's great. Now, essentially, these policies are just like houses. The death benefits like the appreciation, but the equity of a house is just like the cash value. And as that cash value increases, we could take lines of credit against it. And starting out, you take credit, you take loans with the insurance company. Now, when you're in 6 figures plus, I take loans. Banks give me super cheap loans, interest only. I could borrow $200K against my cash value at like 3.25% interest only, making, paying 500 and something bucks a month. Meanwhile, that money's still making 5% in my policy plus whatever I'm using the money on. So my money's working 2 places at once.
Yeah. So it sounds like the policy, and we want to unpack this a little bit for our listeners, right? Because it's double working your money, right? It's double your working money. But you said you got into the policy and they helped you a lot. That was your words that you just said. So my question to you is, when you're in this time, you had these flips going on, escrow money was being taken, you put money in policies. Most people listen to Dave Ramsey. Most people listen and go through and say, dude, a whole life policy is like, mine's like $1,600 a month, right? Like, this thing is just rips cash out from you. How does it help me? Can you unpack that for them? Like, how does these policies actually help us? How is it double working our money and not just taking our money?
That's a great question. And if I was to say this very succinctly, because this comes up all the time, as when I was an investor using these policies, all I cared about was cash value. yes, you get death benefit. It's still life insurance. The IRS came in. See, really rich people used to throw money, millions of dollars in year one of these things and just let it ride out. They have no taxes, all the stuff. The IRS came in the 80s and said, all right, you can't do that. It's still life insurance. You have to have some type of schedule. So this and that. So now there's a ratio between your death benefit and your cash value. And if you go over the ratios, you get trouble with the IRS. That's one thing. The second thing is when we talk whole life insurance, think of it like it's just a box. It's just a category. It's like if you have an IRA. Well, an IRA is an IRA because the IRS comes in and says, if you do these things, you can have an IRA and it's traditional Roth, all this stuff. Well, if someone came to you and said, IRAs suck. That's what Dave Ramsey says. He's saying whole life sucks. Well, if someone came to you and said IRAs suck, my question would be like, well, what do you mean? Like, what's the investment in? Is it in mutual funds? You have a self-directed IRA, all this stuff. There's some very powerful tools. Yeah. Same thing with whole life insurance. So whole life insurance is just a name of a bucket of a product. Now you come into the human factor and greed factor of agents. I'd say 80% of agents set up horrible whole life policies. I'd say the next 10% set up marginal ones. And then there's very few that set up really, really good ones. Now, this company I'm working with is very involved in the veteran community, ADPI insurance. And they wanted me to come on board. They used to see me do these videos and these entrepreneur groups just to do them. And they wanted me to come on and just do what we're doing. And I told them, I'm like, look, I'm only going to write policies I would write for myself. And because I do that, we're going to make less money than all our competitors. However, our clients are going to have the best policy out there. So we'll go head to head because the way we set it up is you're always going to take a little bit of a haircut or a lot of a haircut on the first couple of years. Most policies, if you're putting $1,600 a month in, you're going to be, some policies you have zero cash value for the first year. And I would agree with people that those suck, but those are the ones that the Ramseys are talking about. Right. For us, like our first year, typically on average is you have 80% of your cash value available. So if you put 10K in, you're going to have access to roughly 8K. And that's the worst year. The next year might be 9K plus the 8K. By year 3, dollar for dollar, you put $1 in, it's spitting out $1, give or take. It's, and then year 4, every dollar you put in spits out more year over year. And then, so the reason it helped me, even with investing, and I was in those early years doing it, but I put a good chunk of money in there and I was able to access my cash via loans. Yep. But then when things got better, I was able to backfill all the cash I accessed. So my line of credit went up and I never missed a beat. My death benefit goes up every year. Texas, every state's different, but Texas, creditors can't touch your cash value, guys. That was huge. Like these things are just like a house. So they have liability protection. They have all these protections and you can use them as an asset.
Well, and I love what you said there because you can, like, we're not talking about getting an insurance policy to use the death benefit, right? Like when the average person looks at insurance, they're thinking, okay, well, I'll get term insurance and I'm going to do that in case I die to cover my family. That's not what you're talking about. What you're talking about is using it as a safe haven for your money. And then that money essentially becomes its own bank account that you can pull against, that it's working for you in the policy, right? It's growing. But then you can also take that money, it continues to grow. And instead of dropping to zero, it's still 10 grand. You take the money and you can use it elsewhere as well. So it's growing and you're using it elsewhere.
Yeah.
And like what you said, there's a little bit of a haircut up front. So Gabe, do you have any thoughts?
Yes, I love this. Okay, so we have the high level overview of what we're doing. And so for those who don't know, Derek and I have been friends almost since I started real estate investing, right, bro? Like we've been doing this for a really long time.
Yeah, 2013 maybe, or somewhere around then, long time ago.
Yeah, I want to say before that, but yeah, somewhere in that time. So he's doing this. I'm watching him grow. His business is growing. He's doing other things, and he talks about this whole life policy. I like the idea. If you guys don't or can't tell, he's very knowledgeable in all this stuff. So he starts sharing with me all these things, sending me books, YouTube videos, all this different stuff of, hey, how to get up to date. So that's a little bit because he didn't share too much of his background. But so I've seen him flip and wholesale deals. You're still doing flipping now, right? And wholesaling and stuff like that.
Oh yeah, like since I've wholesaled a few hundred deals. I mean,
right. So,
wholesale, and owner finance were my three big things. I love those.
So we used to do owner finance together. I mean, all types of stuff, guys. So, and when we started doing the creative stuff with owner financing, that's when I saw you put some of this stuff to work. Right. So to help people understand, let's talk about, what are you using these policies for? Like, what are you using this cash for in real estate? I mean, I know you could go buy a car or whatever with it, but how are you using that? Let's just go into some of that creative strategy.
Yeah. So, and to go real quick, a lot of time, like early on, for one, I was getting my teeth kicked in on those flips, but also early on, you might refinance your credit cards and stuff or whatever, right? Because all you're doing is the real estate aside, when this really got super popular with Nelson Nash back in the 80s or whatever, it's because 35% of people's money every month was going to financial institutions via loans, car loans, and all that stuff. And so all it was, look, switch hands, build this cash, pay off your stuff, and then treat yourself like a bank, like a lender, like you were paying them, but now you're paying you, and all that money's, that excess financial money's going into your own bank, right? So that's cool. Real estate just magnifies that on steroids, because all of a sudden, like, I'll buy really cheap houses, right? And like in Harris County, I bought one for like 10K, and I pay cash. I could close tomorrow. That type of stuff, right? Now, I'll use my policies to do that. Someone will come to me and go, well, big deal, I can pay my cash too out of my bank account and all this stuff. And then we go break down the deal. And I could pretty much, when we break down the deal of, all right, you do this one deal, you use your savings account, I use my savings account on steroids / my whole life policy, and then we have this investment. Well, guess what? I can end up doing just about double of what they could when we start laying out the efficiencies of these policies. There's a huge economic efficiency here that people don't realize. People are so focused on that first year. Oh my goodness, I'm, took a little haircut. No way. I mean, good Lord, you look at this, we can go through the illustration, and it's a powerful, powerful tool. And if you have multiple, it just increases it and magnifies it.
Yeah.
Well, and in 2 years, like a 4 year. So mine was a 4-year break even, the one that I got.
Mhm.
Okay. For the policy, dude, 4 years goes by like that. And then all of a sudden you're set up for not only life when you get older, right? You can pull against it for the rest of your life, but also you can use the money for whatever you want. Like, you can pull it, and and I think the thing that was hard for me to grasp, and I imagine it's hard for others, is, why is a loan good, right? Like, why is taking a loan good? Typically, when you take a loan, it's bad, right? It's bad debt. That's what we're taught. It's bad debt.
Right.
But what we don't realize is we're loaning ourselves money, and we're paying ourselves money back. And that's our own bank that's getting the interest. That's our own bank that we're paying back. That is for our benefit later in life. Right. So
Totally.
I love that. So what is this, you mentioned Nelson Nash. What's the strategy here? If someone was to go in and kind of like want to do some research or reach out to, like, what would you recommend they read? What would they look at to kind of get a grasp? Because this is kind of a hard concept. What would you read? What would you go to? What would you look out for? What are some of those areas when you jump into this?
Yeah, great question. So Nelson Nash has a book, he passed away a few years back. He's pretty old. Becoming Your Own Banker. That's like he wrote it decades ago. So some of the illustrations might be a little bit off from today's numbers, but the concepts are the same. He created a group called Infinite Banking. You might have heard that. Now that's an actual marketing name, right? So that's like their program. So I'm not part of their system. So I can't go out there. So we call our thing the Cash Flow Accelerator. everyone has their little marketing name, but it's all on the same chassis of whole life insurance. So I would say go to infinite banking sites and look at those books. You can go to Paradigm Life Insurance with Pat Donahoe. He has a good book. Tails I Win, Heads I Lose. There's What Would the Rockefellers Do is a good book. And what you'll find, this is what you'll find, and this is what to be careful about. You'll find 80% of life insurance agents have no clue what we're even talking about. Now, they'll tell you, if you go to State Farm, and you got Sally from church and you're like, hey, I want to do a whole life. They'll do a whole life policy for you, but it's not what we're talking about. It's going to be the one where you put 10K in on year one and you have zero cash value in year one. Another 10K, you have another 0 year. All right. It's still whole life. Now you got a huge death benefit, but big deal. So here's what I recommend. There are books like that, and people can reach out to me too. Now, once you start getting the knowledge, a lot of us are talking the same exact language, which is great. The problem is, and the differentiator, and I think this is where, and I'll say this confidently, I come in, is I believe we set up the policy better than other competitors that I've seen. And it's not because we have a secret relationship with the life insurance company. We're all using certain life insurance companies, and we're all using life insurance companies that are like the most stable companies in America. But that doesn't mean your policy's good, because now you have an agent that can go, I can have 5 agents and myself use the same insurance company I use, and we come up with 5 different policies based on the same scenario. You're like, hey, write me up for 10K a year for 20 years. We can have the same thing and come up with 5 different policies. Now, part of that is just because know-how. Part of it is some agents work for brokers that are like, this is how you do our policies, and they're not as good. The way we do it is I literally maximize these as much as I would maximize them for myself. And I can prove it to people because I've done it.
Totally.
That means our premium.
To go into that, Derek has done one for me and for my wife. And I was like, maximize this, baby. Let's see what we can push this thing to. So guys, I have seen him. I'm like, wow, that's actually pretty cool. When you do the math on everything, he's got these super calculators and all this other stuff. So like I sometimes text Derek and say, hey, can you put this through your calculator? I want to see how this matches up, because he has these cool things that, I don't care. I want to see the breakdown. I'm not into the plugging in the numbers. And I know Derek is totally into that. So I've seen this stuff happen, guys. So it's pretty cool.
Well, and you don't want to don't even take my words, because agents can play around with the gymnastics. There's dividend rates and there's direct versus non-direct recognition. And you find a decent company, you talk to a couple, you talk to 3 or 4, get 3 or 4 illustrations on the same exact scenario and look at the numbers, because that's what's going to matter 30 years from now. The last thing you want to do is be in a policy 30 years from now and be like, well, crap, man, like this agent, he sounded really good, but I didn't realize.
Yeah, they're no longer in business. They're not around. I totally get it. And so to give everybody a little bit of confidence, what Derek's talking about. Derek, did you go to college?
Yeah. I have an undergrad business finance. I have an MBA as well.
So in business finance, so just to kind of let you know, and I knew this stuff beforehand, like he actually has done some of this stuff before and looked into the finance. That's why we became really good friends, because he actually was showing me the power of just creating notes. And back when I was creating notes, we do have some questions though. So let's go into some of the questions. One of them is from Michael. He says, how do you identify if you have one of those 5% of agents helping you make a good policy?
Yeah, Michael, good question. Yeah, but it's an excellent question. And that's kind of, I just alluded to it. It's probably after you asked, but even if I'm telling you I have the best policy, every agent's probably going to say something similar. Again, some agents say it out of ignorance. They think they do have the best policy. Other agents say it because they just want to sign you up and get a commission. Look, we get commissions. It's no secret. The secret is the commission's based off of the base premium. The commission's based, the lion's share of the commission's based off the base premium. And so we keep our base premium as small as possible, so your cash value could be as high as possible. It's as simple as that. Other agents, their premium, even if it's moderate, okay, cool, it looks better than the crappy guys, but they're still making a lot more money. So compare, get some policies, get our policy, compare it to other people, make sure that we earn your trust and that we get this thing written up. And I tell people all the time, like, it might not be for you. I'll show you my books. I'll go into my policies. I put a decent chunk of money in them. I believe in it. So either I'm an idiot for believing in it or I'm onto something here and I can show it. Right. So
Derek, for those who don't know, I know this is going out on the podcast also, but we are sharing his link. We'll put a share link also in the show notes. And I just put his contact information in our chat for those who are asking. So let's transition to something, because I know hopefully we get a bunch of these that ask more questions for Derek, because he has a ton. The utility of this for someone who might be a lender. Okay. Now, I have two of my major lenders are whole life guys. Like they're literally pulling their money out of their policy. Some of them are older. Some of them are literally our age, right? Where they're just going in and saying, hey, I stacked this baby up so I can lend out of it. What are you seeing with those folks, Derek?
From a private lender standpoint, and I've raised a lot of money like you guys for deals and stuff. To be honest, most private lenders are using either their retirement money, like IRAs, 401ks. I have not personally seen lenders using, I know you talked about yours and you've told me that in the past. However, it's an absolute gold mine. I mean, look, it depends on how much you put it. If you're putting $300 a month in, that's $3,600 a year. It's going to take a little bit to get a decent amount. If you're putting $100K a year in, you're going to grow faster. If you're putting $500K, the cool thing about this, people often ask me like, well, how many of these can I have? And I'll go back to real estate. How many rentals can you buy? I don't know. It depends on you, right? You go to the bank or whatever it is. And it depends on your file, how much you may, or all these factors, right? Same with insurance. Like if you work at Burger King, you can't get out, you can't be putting $100K into a policy. Like they're going to check that, but there's minimums, like you can get in pretty easy for a good, decent amount of stuff. And then as you get higher net worth, maybe we send a form in saying this is net worth. And they're like, okay, cool. But it's an absolute gold mine for lenders. And I'll tell you this too, talking to a bank, because I get banks lending on my cash value because I have multiple six figures in there and they love it. They're like, this is the best investment for us because it's guaranteed. Like if I disappeared, literally all they would do is they'd call the insurance company and say, all right, I want my money back because we put a collateral assignment on it. But the lady at the bank said, this is a booming business. She's like, no one knows about it other than bankers and stuff. So all these big time investors, they're using it for, I would assume, private lending or just for their own deals or to fluff up their own deals, or there's all kinds of reasons. But yeah, it's pretty big.
Go into that part real quick when you're saying about the different policies and how you can have them for different people. It's really, I was introduced by Whole Life from Derek, right? And now I have quite a few friends that totally are into this at a very high level. Like this is where like I said, one of them is where I could lend any amount of money and he can lend it out from his policy, or I could borrow any amount. How many of these policies can you have? Like, how does it work out with your spouse now, with your kids? Like, what does that look like?
Yeah, good question. So like I own 6 policies. So I have 2, there's three parties to every policy. You have the owner of the policy, though that's typically the person who pays the premium, who starts the application. Then you have the insured. It's whose life is insured. If they die, the benefit gets paid out. And then you have the beneficiary who's getting the payment, right? So you could, in most scenarios, you could be 2 of the 3. So I own 6 policies. So I have 2 where I'm the insured, meaning my wife, my family gets the beneficiary, the stuff. I have 1 where my wife's the insured. And then I have 1 on each of my kids. And those 3 came out more recently, right? Now, my first policy was like $6K a year, right? My second one was $25K a year. You start adding these policies together. And if people are like, well, is it better to split them up or to do them all at once? Well, I mean, if I had all the money, I probably would have done it from day one, but that's typically not super realistic, as most of us make more later. And then, or it's the tiptoe, right? Like, I think this is right, but I'm going to put a little bit of money in and make sure. And then once it clicks, and they're like, all right, I'm all in.
Game on. Ronnie, what you got?
Sorry, I was trying to unmute myself. That's so good. So you're able to stack it. So depending on your financial position, we're able to stack it up and put cash value aside to essentially cause your money to start working overdrive for you. And it works as and we didn't necessarily, it works as a bank for you that is constantly earning money. Now, I would like to touch on, I actually have a couple things, but I think first, we've touched on the death benefit. When you die, it's insurance, right? Your beneficiary gets the money. It works as a place to put your cash where you can pull that money up and it gains interest still, right? It's still, is it dividends? Is it this? Like, I'd like you to go into that a little bit. And then thirdly, this is also a retirement plan, right? Like, because mine is set up for a retirement plan. And you said you had 6. Like, I was looking at, I have one, my wife has one. And then we were looking at setting up one for each of our kids, right? On each of our kids as kind of like a family banking process. How does the long-term retirement look like? Like, what is that? Because that's a huge aspect to the strategies. It's not just, it can be my bank and I can pull my money out. It's insurance, but it also sets you up for 20 years from now. You've had this policy for 20 years and you've had consistent returns of whatever that may be. And then I have one more question after that. Once you dig into that.
Yeah. So dividend and interest. Do you want me to hit that first, or you want me to hit the retirement piece? Okay.
Yeah, let's hit that first.
Yeah. So how do these policies grow? And we're using mutual companies, high cash value, dividend paying, whole life companies, right? And there's a select few that we would ever use. These companies have a guarantee. So when I get a policy, it's a contract between me and the insurance company, right? They guarantee you're going to make something. Maybe it's at the end of the day, it's 2%. Now, always be careful with percents. Always be careful with dividend rates, because at the end of the day, and this is the smoke and mirrors that confuses people. If a life insurance company says our dividend rate is 6.8% this year, it doesn't mean you're making 6.8%. It just means that's a factor they're using with other factors that come out. The way you know what your policy's making, Gabe alluded to it. We have calculators that I could spit it in and it shows the rate of return. So I could show you that I'm making around 5%, give or take. It switches a little bit every year. So I always tell people between 4 and 6%. That's in this low interest environment. We can talk about that later. But so the company's guaranteeing you're going to make something. Maybe it ends up being 2 or 3%. Okay. That means if they don't pay a dividend, dividends are not guaranteed, but the stock market could crash, all this stuff, and you're going to make 2 or 3%. And remember, the first thing is we want to protect our money. Now, dividends are not guaranteed, but one company we use, they pay dividends since they started, and that was in 1847. Before the Civil War, they paid a dividend every single year. World Wars, I mean, these are like the strongest companies in America. There's other really good life insurance companies. They've paid, maybe not since the year they started, but well over 100 years, well into the 1800s, every single year. So they just can't guarantee it, because at the end of the day, dividends are based off of performance and output of obligations, things like that. But again, these are very conservative companies. These companies aren't just approving everyone for any reason, right? So, I mean, they are conservative in that regard. Now, retirement. Yes, these all flow on each other. Now, like with the kids, I own the policy with the kids. So it depends on what your temperature is. I want to train them as they're young. They're going to start taking loans from their bank. I'll give them like an allotment, and then, they want to buy something. All right, we're going to take a loan for the bank, and then we got to pay it back. Just start teaching them basic principles here. Now, some people might say when they're 21, I'm going to give it to them. As the owner of a policy, I could transfer it to you if I wanted to. I could transfer it to anyone. Some people will transfer it to a trust, and now you have more of the trusts and the rules and stuff. But yeah, especially the kids. And there's a couple of reasons to get them for the kids. One is, or to get them for anyone really. If your kids are healthy, what if something happens in a couple of years, God forbid, and they get a disease or something? They can't get life insurance. Well, they're already in. They can't take insurance away from you.
Yep.
So that's one good thing. The other thing, kids are young and it's going to compound a lot longer. Now, when you get into that retirement age, And traditionally, that's what a lot of these were good for, is like people wanted to create their own pension or something, right? Well, what's really cool is like, let's say you have $1 million in your cash value and you're, I don't know, 70 years old. Well, if you had $1 million in your mutual fund with a traditional financial guy and you're 70 years old, because we always do apples to apples. Probably when you were 50, you got more conservative investments, and 60 more. You're probably not even making 5%. By the way, to make 5% without taxes, you got to make about 7% in a taxable account, just to compare with our little savings account. Now, let's say the guy's like, all right, I want to take 100K out for the next 10 years. All right, cool. The mutual fund, it could be a Roth IRA, whatever. We won't even talk about those things, but if they have $1 million, they take out 100K. Now they have 900K. Now they have 800K. Not with whole life. If they take out $1 million, or I'm sorry, they have $1 million. If they take out 100K, it might go down by like 40K, because the money's working in two places at the same time. You're still offsetting a much of that 100K. So your money's going much farther. You're going to get way more money out of it. And you're still probably going to have a death benefit to your family. And you could be taking loans and you don't have to pay them back. I mean, there's all kinds of cool stuff, but that's kind of the big picture. Yeah.
That's so amazing, because guys, the way this plays out is, recap, you can put your cash into the policy and you can pull that cash out to use for your real estate investment. All right. So let's say I have 30 grand in my policy and there's a $30,000 cash benefit. And let's say I go out and get a hard money loan. And when I get the hard money loan, my cash to close is, let's say, $10,000, and it's going to be a $30,000 rehab. I can go to my personal policy with 30 grand into it. I can get my hard money loan, and then I can go and pull a loan from my own policy. So I'm the owner of that policy. I can pull a loan from myself, use that cash to do my rehab. It's still making its interest at the bank. Then I repay it. Now let's fast forward now, and I'm 70 years old. And like what Derek just said, I'm 70 years old. I've got $1 million in that policy now. It's grown. So over time, I've been using real estate. I've been paying myself back. Everything's working great. Well, now it's like, you know what? I'm done working. I want to pull my livelihood. I don't want to pull 100 grand. I want to pull 12 grand a month, right? To pay for my life. Well, as I'm pulling 12 grand a month, that consistent return of whatever the dividend is will continue to accumulate on that top value, on the top value of $1 million. So you will make interest on that $1 million while I'm pulling out a $12,000 loan every single month. What will happen is, at least in my case, the way my policy is, the amount of money I use to live on will actually be outpaced by my interest on my cash value. So I will never run out of money in retirement. And so you're able to use the cash now. You're able to have it double working for you, and you're able to have yourself set up for retirement without having to slop money into an IRA or a Roth that you can't use today. So my next question, as a result of that, Derek, because I think you did a freaking great job explaining that. I love it. This stuff gets me so excited. What if I get into a pickle? Let's say I get into a pickle 3 years from now, right? Like let's say I get a $50,000 a year policy because I'm making good money today. Let's say 30 of it goes into cash value per year for your first 3 years. You break even at 4 years. I'm just using kind of the numbers from my policy. Yeah. And let's say in 5 years, I'm in a financial pickle and it's like, dude, I can't even afford the base monthly amount. Is there anything I can do to not lose this policy? Like, what does that look like? Like, do I have to, have to come up? Like, what are the options there? Because I know that was a fear of mine. And I know that can be a fear of other people's, of like, hopefully shit doesn't hit the fan. But if it does, what do I do?
That's a good fear. That was my fear too, because I was self-employed at the time. I did a kind of, for at the time, kind of aggressive. And I'm like, I have the money now, but same thing, 3-4 years from now. So of course, if you're using your policy like a good banker, hopefully you have some cash value in there. You can always borrow from your cash value to pay your policy, right? That's one thing you can do. That's an obvious one, but I don't know. Let's say you had the next question.
That's not an obvious one. I think that for me, that's incredible. Like,
Yeah.
guys, you can literally pull the cash value. Like, if you've got 50 grand in it, you've been paying it off. You've gotten past the break even point in 4 years or whatever your break even point is. And let's say in that example, you have 200 grand in there and you're in a pickle and your base premium cost is 20 grand. You can borrow the money from yourself to pay it. Guys, that's so powerful. I just want to stop there because I know it's basic, but it's incredible. Anyway, keep going. Sorry.
Yeah. So that's one thing. The other thing is, and you kind of alluded to it, you said if you don't have the money for the base, so that 50K gets chopped up, right? Let's just say, I know the policies I'm familiar with. Let's say 10K is going to your base and 40K is going to all the fun stuff, right? Well, literally, and I figured this out as as just a client, but literally in the paperwork, the policy is basically saying you have to pay this 10K to keep this thing alive. This 40K, I mean, think about it. The life insurance companies don't care about our little bank on ourselves and all this. I mean, they're life insurance companies, right? They've already underwrote you for you're going to die. They already know you're going to die barring an accident or something. I mean, they're pretty good at this stuff. So now you have to come up with 10K instead of 50K, which theoretically you could come up with 10K easier than 50K. But let's just say you didn't even have that. Let's just say you squandered all your cash value on a Mercedes or something. I don't know. Well, now what can you do? Well, you can always go down. You can always do like some non-forfeiture options or maybe decrease your death benefit to make it cheaper. I mean, there's all these compression techniques you can do. Or you could switch your policy to monthly. So now you don't have to come up with the 10K, but now you have to come up with $833 a month. And maybe, entrepreneur, we're buying time. Maybe, we can dig out of this in 6 months, a year. And then a lot of companies, even if you paid that minimum 10K, yeah, it sucks you didn't pay the 40, but a lot of companies the next year, they'll let you backfill what you missed out the previous year. And so you can kind of catch up a little bit. Obviously, there's things to that, but to answer your question, it's not like they come down with a hammer after 30 days, you don't pay them, like, bam, you're done.
Well, and guys, the guys who are listening to this, if you get anything out of it, don't be scared by all the different options. Instead, be encouraged that there's so much flexibility. And I think that's where it comes in at, is there's an incredible amount of flexibility with the gain that Derek is talking about, that it literally causes you to speed up your rapid rate of cash when you have the cash. And it allows you to be very flexible when you're tight on cash. And those two things, being able to maximize my upside and limit my downside, gosh, that's what sign me up, right? Like, sign me up for that. I want to minimize my downside and maximize my upside all the way while setting myself up for retirement. That was one of the reasons why Gabe's like, yo, I got Derek to talk about whole life. I'm like, I'm down with this. I love this. and so to kind of tie back, so to the beginning, because we're 42 minutes in. Multiple policies. You can use it for real estate. You can use it for the investing. If I wanted to get started today, if I'm like, you know what, I've flipped 15 homes. I'm well into my second year flipping. I've got a full-time job. This guy's talking about maximizing a cash. I got a couple $100,000 in the bank. What do I do? Like, what should I be looking at?
Yeah, well, first thing you would want to get with, you want to get illustrations. You'd want to talk to some agents. You want to make sure you kind of get a feel for them and get an illustration. So if someone comes to me, I break down everything. I answer the questions. I have a webinar I can send them if they're brand new, just for the basics, that way our call's a little better. But then we get some illustrations. I explain every single piece. I explain where the money's going. And usually people are pretty cool with that and they understand it. And I'm happy to compare anything. But if someone really wants to get started, I mean, it's simple as we start an application and they go through the process. It's all online. They go through underwriting and all that stuff. And we get going on that. So that piece is super, super simple. The hardest piece, and the piece I want to give people the most caution on, is making sure you're getting into a good policy. Okay. And how do you know that? Because I can't sit with people in interviews on their shoulder. But the best thing I can tell you is to compare. Use us to compare with everybody. I mean, seriously, I've seen so many bad policies. And if you're in a bad policy, let's say you look at your whole life, you're like, I got one of these 8 years ago, and it's like, man, I'm not even breaking even yet until like 3 more years. Insurance, we could do what they call a 1035 exchange. You could take your cash value from your current policy, do a tax, there's no taxes or anything, put that into the new policy in cash value and start a new policy while bringing over your cash. It's called a 1035 exchange. Super easy, not to get confused with the 1031, of course, for real estate folks. But yeah, I mean, we do that all the time too. And sometimes it's better to do that because of the efficiency of just the policy in general. I want to say one quick thing too. How do you get money in these things? As an investor, what did I used to do a flip, right? And so you have to save some money for taxes. Well, what was I doing? I was saving it in my Chase account, right? Chunks of taxes. So now what do? I throw it into my policy. It satisfies a chunk of premium. Once you get, like what Ronnie was saying, once you get to that year 3, 4, 5, 6, whenever you're breaking even, I could literally put $5,000 in my policy the next day, request a loan to get it right back out. And I satisfied a $5K piece. Now I got a loan, but I could throw that money back in as I have it. I mean, there's so many cool strategies, especially that I learned as just a client of this, that I can now, as an agent, I see the other side too. It's really cool.
So for those who don't know, this is like a never-ending great topic. Derek has sent me podcasts and other cool things that maybe Derek can share with you if you guys want to connect with him. This is the conversation that he loves to have, is really the creative financing part, which is really odd because that's kind of how I know Ronnie is through creative financing and how to create notes in mass volume. And now we're here, guys, many years later, right, and making this thing happen. So this is so cool. So for those who might have just chirped on or kind of seen what Derek is about and how to do creative strategies, you can go to our YouTube page, Facebook page. We're posting this on our personal stuff, putting on Derek's stuff. He'll probably put that out there. Contact him if you want to know more information about how he's doing this for real estate investing, how he's setting his family up. It really wasn't that complicated at all. It's just a matter of knowing your policy. It really takes the longest time. And then once you say yes, I mean, you go, you get your clinical check or whatnot, they pull your blood and you're good. And then, you're able to move forward from there. So it's really not that hard to do. So just to wrap up what we're doing, Ronnie, you got anything else to share or topics or anything like that?
I can share a final thought.
You have a thought.
I do.
All right.
So guys, insurance and Derek, I hope you agree with this. This is kind of the way I look at it is insurance is like the foundation to your financial house. Is if you can set insurance up, not only does it protect you in case stuff goes wrong in life, but it also provides that base to build, whether it's real estate investing, whether it's another type of enterprise like crypto, whether it's whatever, it gives you a solid foundation and principles for rapidly increasing your money. And it's going to take some time to wrap your head around the strategy and all the different flexibilities and this and that. But if you can lay the foundation, it provides an opportunity for you to be flexible with real estate investing, with crypto investing, with where do I want to put my money? How's my family set up in case I die, right? How do I save money? How do I set myself up for retirement without that money not being accessible? If you can set that right foundation, and this is what like the Dave Ramsey's and stuff they don't talk about. I like to say they get you from -2 to 0. But to get from 0 to 10 on the financial scale, like you need some other strategies. And this is one of them. And this is that foundation that really can set us up to live a life of just wealth, right? To live a wealthy life. And so I'm super passionate about it. But that would be my final thought is think of this, take some time and just think of it as, hey, I'm pouring concrete to a foundation of my house, and it's going to be the foundation to my financial decisions. And guys, I promise you, it will cause light bulbs to go off. Like, I didn't even know I can do that. I didn't know, right? And it's amazing. So that's my final thought with this topic.
Word. Hey guys, just to let you know, like us, share it. If you have more questions for Derek, let us know. Or for us, if you're just getting involved with real estate investing and want to know more about real estate investing, or just avenues, contacts, people to call, people to know, stuff like that. I wish we had services like this back in like 2011 and 12. Like, it was ridiculous for me to even think about that. And it's really like all of us here have had our lives transformed after 2008, right? So we didn't really go through the 2008 stuff, but our life has been transformed by real estate, by creative financing, by learning how to put our money to work in other areas, and not just W-2, not that there's anything wrong with it, but using those avenues to create freedom in many ways. So you guys travel. Derek's been traveling, and he's moved to a whole nother state and still can he's doing deals in Houston and moved to a whole nother state. So that's what I really like about this. Derek, you have any last words?
Just, the group I'm with, they pulled my arm to be with them. It's a veteran organization. Active Duty Passive Income's their name. They do real estate education, obviously very much for military and veterans. But as far as our whole life stuff, we do it with anybody. And we call our product the Cash Flow Accelerator. But the concept that we use is, I coined the word bankonomics. So that's just how we do it. It's our cheeseburger, right? And so not everyone's going to like it, I guess, but we have our own little recipe, and that's how we stand out, and we just want to help people. And yeah, if people want to reach out to me, I see you post the link, feel free. And man, I really appreciate you guys having me on.
Sweet. All right, guys. Well, thank you so much for joining, Derek. I appreciate you. Definitely love to see your face and see everything that's going on in your world. Guys, we'll see you later. Welcome to the Power Play, and we'll talk to you guys later. Peace.
Peace.
Take care.